The advanced Western economies have monopolised the headlines in recent months, with emerging markets, the usual locus of volatility and heterodoxy, taking a supporting role in the global story. But with risks confronting the outlook for trade, commodities, currencies and international relations, the outlook for emerging markets is as nuanced and as uncertain as ever. To take a closer look at this picture, I'm joined by Felix Delbruck from our Asia team. Felix,
Alasdair.
Hi. Emerging markets. So what are the highlights as we look out for the year ahead? What are the sort of main drivers for the story in emerging markets? What should we be looking out for?
Well, we actually think that 2017 will be a slightly better year for emerging markets on the whole than 2016 was. There's a few reasons for that. One of them is pure arithmetic. There's some very large economies that were in deep recessions for several years actually, and are now coming out the other side. So I'm thinking particularly of Brazil here and of Russia. Now, it's no coincidence that both of those economies are oil exporting economies. Of course, we have had a partial recovery in oil prices and other commodity prices over the last year, and we're expecting that to continue to some extent this year. That will help those economies and other commodity exporting economies. You could almost say the commodity prices are in a bit of a sweet spot this year. They've improved, which is good for the exporters, but they haven't risen so far that they're going to choke off growth for everyone else. And I suppose related to that, inflation is picking up. We will see it pick up this year compared to last year. And as a result of that, interest rates have risen, as we all know, and US bond yields are a great example of that. I think it's important to remember that those interest rates are still very low by historical standards, and we're not expecting them to rise too much further this year. So there was a lot of speculation after Donald Trump gained the US presidency that there would be this big reflationary infrastructure drive in the US and that would push up inflation and global interest rates. We were always a bit skeptical about how much he would be able to push through, and I suppose the fact that markets have themselves cooled a little bit on that gives us some comfort in that view. So US bond yields have retraced a bit. A lot of emerging market currencies are, if anything, as high as they were before the US election.
Okay, that sounds like a bit of a Goldilocks year ahead for emerging markets. I'm sure it's not sanguine across the board. There must be some exceptions out there that we should keep an eye on. Take us through that.
There are always exceptions. In some cases, there's just domestic factors which are so powerful that they override anything that might be going on globally. So Venezuela is an obvious example. We're expecting that to remain in recession this year while President Maduro clings on to power. That's not going to change. Mexico, of course, has been in the headlines a lot this month. The peso has tanked. Consumer confidence is at a record low there. We're actually expecting modest growth in Mexico this year. That's on the assumption that the sort of protectionist measures coming out of the US against Mexico remain largely symbolic. But there's, of course, a big risk that they go beyond that, and we could easily see Mexico falling into recession. So you've got those kinds of exceptions where a country might find itself in the crosshairs of US trade policy. We shouldn't take that too far, though. So I'd like to propose a counterexample to that. We're actually very upbeat on Iran this year. Of course, also in the crosshairs of US foreign policy at the moment. It's quite likely that we will see new sanctions against Iran from the US side. But unlike Mexico, Iran has just got so many more options in terms of who it trades with and who invests there. So we actually think that Iran will stick to the broad terms of the nuclear deal that was agreed in 2015, and that means that everyone outside the US who still wants to invest in Iran probably will continue to do so. In the long term, it's a very attractive country to invest in. So we're actually expecting growth above 5% in Iran this year. Now, of course, there's a lot of risks around that, but I think that's somewhere where we can still be cautiously optimistic.
It's interesting to see this sort of flow of risk from the developed world to the emerging markets, which normally, obviously, traditionally is the other way around. Okay, we haven't mentioned, the big beast in emerging markets. In fact, in any conversation about the global outlook, China. I know that we've talked about this in previous recordings, that we are expecting some shift in Chinese policy after the Politburo meeting at the end of this year. Could you take us through the numbers for 2018 for China, what we're expecting there?
Sure. So we did go through China a little bit last month, but let me just recap the story a little bit. So the issue in China is that debt levels are extraordinarily high. They're still growing at very rapid rates, and that's just not sustainable. So at some point that has to slow. And unfortunately, the entire economy has become so bound up with this credit creation that if credit growth slows, the economy slows. So that puts the Chinese government in an obvious bind, and we think that politics will determine what happens and when it happens. So, as you said, at the end of this year, we've got a very high level leadership reshuffle in China. It happens every 5 years. Until then, the priority will be to keep the show on the road. But I think that once that's out of the way, provided that President Xi is able to bolster his support base in that reshuffle, we'll see bolder moves to curb that credit growth. And we will see an impact on Chinese economic growth. Now, the headline numbers that we have, they look rather dramatic. So we estimate that growth this year was just above 6%, or will be just above 6%. We see that slowing to just above 4% in 2018. So these are dramatic numbers, but the important thing about this view is that we think that there's still a decent chance that it will be a managed slowdown driven from the top rather than something far more disorderly. Now, of course, the longer you wait in dealing with this, the greater the chance that it does become disorderly. But if they deal with it early next year, this is what we think that will happen. And what that means is that the slowdown should be fairly concentrated in the problem areas, heavy industry, construction, that kind of thing, but it shouldn't become too pervasive. And other parts of the Chinese economy, which are maybe more consumer-centric or more services-based, should keep going. But of course, there are big risks around that, and there is a chance that things could get messier than we're currently assuming they will be.
So a challenging year then in 2018 for China, and of course, given China's preponderance in the global outlook, that spells a challenging year for the rest of the global economy. Could you follow through how this plays out in emerging markets in general in 2018 and beyond?
Well, if we're right, and what we'll get in China is an orderly and managed slowdown, which is concentrated in particular sectors, then certainly not everybody will be affected equally by this. So if you're a country that exports raw materials to Chinese heavy industry, or you supply heavy industry in some other way, and that's important for your economy, then clearly you will be in the front line of this. I'm thinking of countries like Australia here, or South Korea. But if you're more exposed to, if you're more consumer-oriented, for example, things might not look quite so bad in this scenario. Importantly, we don't think that oil prices will collapse as a result of this. To be sure, we don't think that they'll continue to increase. at the same pace as they have done recently. Conditions will remain difficult for the key oil exporters, but on this scenario, on the central view, we don't expect them to get significantly worse. We also don't think that the China slowdown will significantly derail the investment push that China's made into large parts of Asia, the Middle East and North Africa, the One Belt, One Road project. That's been a very important driver of investment and growth in many economies. We think that will broadly continue. And we also don't think that the China slowdown will put an end to expansion in the US in 2018 or to monetary tightening in 2018. So we're still expecting two rate hikes from the Fed this year and 2 more next year. Now we do expect the US economy to go into its own downturn in 2019, so that'll be the thing to watch in 2019, but that's largely driven by US centric issues. Basically, the US is already at full employment or even above. At some point it will overheat, it will have to slow, but we don't think at this stage that there will be major spillovers from China to the US.
Okay, thank you very much, Felix. Well, it sounds as if a lot depends on China taking policy action in 2018 in a timely manner. And in any case, it looks like we're looking at a very different 2018 from 2017. Well, that's it for this month. We'll be back again next month to have another look through the outlook for the global economy. Please join us then. Thank you.